Making estimated tax payments to the IRS is a little bit like paying your utility bills. While neither is particularly thrilling, it's crucial to pay the correct amount. For utilities, it ensures your service remains uninterrupted. For taxes, it helps you avoid penalties and reduces the chance of being audited.
Today we get to talk about taxes. I know, really exciting for both of us and our audience. And today we get to talk about estimated tax payments and why we do those. And chiefly it's because we have income that we're not paying tax on. So whether this is a side gig that we get some income as a consultant, or whether we have investments and they're in a non-qualified account, we get some dividends, some interest, some capital gains there. We've got to find a way to pay taxes on that. Otherwise, we're going to be having a significant tax bill at the end of the year and also kind of increase probably our audit risk there. So we'll dive into these different things. So making quarterly estimated payments, you want to kind of kick us off here, Austin?
Yeah, so quarterly payments, just like you talked about, there's two crucial elements here. Is one, we want to avoid penalties. If you underpay, the IRS can actually charge you a penalty. And so we want to make sure that we are paying the right amount. Similarly, you don't want to overpay significantly and leave a tip to the IRS. You're giving them a 0% loan if you give them too much money through the year. So we really want to try to get as close as we can to not making too much nor making too little. It's really punitive to be too little. If you make too much, you'll get a refund back of the overpayment. But the reality here is we want to really try to avoid those penalties. The second big reason is financial planning. And so we want to make sure that as income comes in, we are paying taxes on it going out. If you have W-2 income, typically this is withheld from your paycheck. But like you were saying, if you own a rental home, if you have dividends that are paid in a non-qualified account, the IRS wants you to make those payments throughout the year, not just at the end of the year. And so really we need to take a look and see, where are all those income sources? Are we making enough payments? Are you having enough withheld on your paycheck? And how can we true up to make sure that we don't have those penalties incurred? And so what we need to do is we need to, again, take a look at that entire financial plan and determine what is that amount that we need to pay.
Well, and as we put together that financial plan, it also cues us in that there may be payments or taxes that we're paying here that if we restructure things a little bit, we might not be paying those. So for instance, one idea would be we take non-qualified resources that you'd have to pay tax on, the dividends, the interest, and we slide those over into a Roth account by contributions over time. So there's ways that even as we do the financial planning here, as we see the cash flow, as we work with the financial advisor, we could say, okay, this may not be the best path. You may not have to make estimated payments in the future if we can adjust some things. So again, that financial planning piece is just a good way to make sure that we're looking at all the pieces together.
Yeah. All right, so let's jump into how you actually calculate these payments. Again, work with your financial advisor, work with a CPA on this. But first, you just start by estimating your income. You look at how much you're making in your earnings, how much capital gains is going to be estimated. Sometimes you can look at the prior couple of years of the funds that you're invested in a non-qualified account. Are there any dividends? Are there any distributions that you are expecting? Any interest that you're earning on your bank account statements? Oftentimes this it hasn't been a huge issue in the past, but now with interest rates being 5%, if you've got a substantial amount in a savings account, then that could be something that you really need to account for. So once you've got your earnings estimated, then you want to calculate your taxable income, subtract any deductions and exemptions that you may have. If you're investing in your HSA, if you've got kids, all these other things, you want to make sure you're accounting for all of those elements. Next, you need to determine your tax liability. There's software that you can use, but you can also just take the tax rates that the IRS provides, grab out a pen and piece of paper and write it out and try to calculate it yourself. Then you want to make sure you're subtracting any withholdings and tax credits that you may receive. And then you take that aggregate amount, let's say it's $10,000, you divide it by 4, and then you make those quarterly estimated payments. So that's kind of the general guidelines of how we would say to walk through this. Spencer, you want to walk us through a couple of example scenarios here?
Yeah, and as we look at these, of course, this is going to be off in some way, shape, or form for every client. So mileage will vary here, but let's just say you had total income of about $100,000 in a year, that you estimated that you had $10,000 in deductions. And so your taxable income here after those deductions would be $90,000. Let's say that you estimate that you have a tax liability on that $90,000 of $15,000, but that you have $5,000 in withholdings and credits. So your liability is going to be that $15,000 minus $5,000 that you've already paid for, you have the credits for. So you have $10,000, again, of liability that you don't have any source to pay it there. So you need to pay it as an estimated payment in all likelihood. As we think about that, you can divide that out over those 4 quarters. And so in this example, you'd have an estimated payment of $2,500 on a quarterly basis, and could spread that out over the course of the year. Now, more likely would actually be, or more typical, I should say, of clients that we would serve is they have some income that might be W-2 income. So they're working for an employer and that they're having tax paid on the income that they make there. But they don't have tax withheld on, say, some of those other types of assets. So let's just say they've received an inheritance and they have $600,000 in an unqualified account, and that ends up paying them out about $25,000 of dividends and interest income. Well, if they had perfect withholding for the $100,000 of income via their W-2 and had, the $15,000 again, let's just say of their tax liability, if they had that withheld perfectly from each paycheck, they would still have a tax liability there based on those dividend income and interest income from that non-qualified account. So again, in this example, let's just say they have about $25,000 of income, and let's say they have about $4,000 of tax that would be due on that income, again, in that non-qualified account. Well, they might need to do estimated payments then of about $1,000 on a quarterly basis because they have $4,000 of tax that would be due. Again, there's no other way to be able to pay the IRS just from your investment account if it's a non-qualified account. There, of course, if you're taking IRA distributions or annuity distributions or something like that, then you can have tax withheld. But in a non-qualified account, there's no way. Same thing would be said if you have consulting income, let's just say, and now you might have both FICA and federal income tax that needs to be paid for there. You might need to make some estimated payments to pay both of those pieces.
Right. Well, I think that can be surprising, especially if you receive an inheritance and it goes in an unqualified account. You're like, this is great. And then you realize, oh, I'm getting dividends, but I'm not, maybe you're reinvesting the dividends. So you're not actually taking it as income. So it's not income that you maybe see coming into your pocket, but the IRS still expects taxes to be paid. And so this is one of the key things that we need to focus on in a financial plan and to know with the IRS is as income comes in, whether it comes into your pocket or just reinvested in an account, the IRS expects you to make payment as the income is generated. And so they don't want you to defer payment until the end of the year. They say, okay, if you have $1,000 in estimated taxes due because of dividends that were paid through the quarter, the IRS wants their $1,000 that quarter.
Exactly. Well, and as we think about this and making the payments, oftentimes clients don't realize that as they would receive an inheritance or maybe they structure their investments in a particular way, not all strategies are created equal in non-qualified accounts in particular. They may receive resources and they say, well, I've heard that I have a step up in cost basis. I'm not going to have any tax due on that inheritance. And that may be exactly true for the moment they receive the inheritance. But then thereafter, let's just say they receive it mid-year and towards the end of the year, the mutual funds that they have in that investment start paying out capital gains distributions. Why they could have a significant capital gain that is due for tax that year, along with dividends and other interest income and such. And so it can be sticker shock if they have not really thought through, okay, how am I going to structure things going forward? Because this set of resources is not really structured in a tax efficient way.
Right. All right. So let's shift now that we kind of know the framework. Let's actually talk about how we do this. So we've talked about when you have a tax liability, you make the payment. Well, how do you make the payment?
Right.
It's actually fairly simple. There's 3 options. You can make online payments. You can log into the IRS website and they will take your money at any time. And they will say, thank you so much. We'll send you a bill if this was not enough.
Right.
But you make an online payment. You get on the website, you submit the payment based on the income for that quarter. So let's say you sell a property in a real estate property. They expect you to make the payment based on the capital gains if there are capital gains due within that quarter. So make sure that you're making that payment within that time frame. The second is you can always mail them a check. I don't know if you want to trust the US Postal Service if you're sending a large check to the IRS. So take some caution with this. Make sure that you maybe have a certified mail or get a return receipt. Just make sure that the check actually gets to the IRS. You'll want to check and make sure that you are sending it to the correct state based on where the correct address for the IRS for your state. Third, you can call the IRS and make a payment over the phone. It's secure, it's safe, especially if you're on the go and can't log onto the website or whatever. So you can do that. Some important details to note. Estimated payments are due April 15th, June 15th, September 15th, and then January 15th of the following year. So let's say you are in the year 2024 and you are paying taxes for 2024 or for income incurred in 2024. The first payment would be April 15th of 2024. Second is June 15th of 2024, September 15th of 2024. The January payment would actually be January 15th of 2025 based on 2024 income. So just make sure that you're making those payments at the right time to avoid any late payments or underpayment penalties.
Right, and we didn't misspeak there. It is a little bit wonky. You do end up with 2 payments in the second quarter. Basically, the way the IRS looks at it is says, okay, well, you've probably been looking at your last year's situation, and so we just want your first quarter payment again by April 15th. But then in the second and third quarter, they want their payments towards the end of that quarter, and then they're going to give you a little bit more grace in that last quarter and let you just pay in January. So it's a little bit weird. Clients have to get used to it if they're making estimated payments because it's not every 3 months specifically. It's kind of like that.
Right. And as always, with anything tax related, make sure that you're keeping good records. So some mistakes to avoid: underestimating your income. If you don't make sure that you are accounting for all of your income sources, there could be penalties that you are levied. You may have to make another payment once you get your final tax bill. Again, if this is $100, maybe that's not substantial, but if you've underpaid by $1,000, $2,000, you don't want to also have a penalty due or get audited because you underestimated.
Well, and this is one of those that sometimes sneaks up on clients because they don't realize, for instance, that savings bonds that they cash in are going to have some extra interest that they've been accruing over time, but they haven't paid the tax on that. Or it might be a CD with a similar circumstance, or they might say it's time to be through with this whole life insurance policy and I'm going to take out the proceeds. Well, there may be a little bit of a tax bill there too. So there's a number of different ways that even those clients that tend to be fairly meticulous can miss some income in here that we need to, again, incorporate that in the financial plan.
Yeah. Second mistake you want to avoid is missing any of those deadlines. Like you talked about, 2 payments in the second quarter. That can be a little bit wonky. So make sure that you are aware of those deadlines. You don't want to have any penalties or interest the IRS charges you.
Right.
The third mistake, ignoring changes in tax law. The IRS, the US Congress, loves to change tax law around. So make sure that you're up to date with your tax law. Talk to your CPA, do the research. The IRS has lots of pages of information that you can look through if you really want to dive into tax law. So just make sure that you're up to date there. So Spencer, you want to talk us through just ways that we can avoid underpayments?
Yeah, so if you look at this and you say, well, goodness, I'm not really sure what my income is going to be. Maybe you look at it and say, I'm going to sell this big real estate property and I might have over $100,000 of gain, or depreciation recapture or other kinds of income there. And it might not happen until the end of the year. How can I make sure that I pay enough through the year so that at least I'm going to not be penalized? Well, the first way is that if you pay at least 90% of your current tax year's liability. Now, again, that can be hard if we're not really sure what's going to happen towards the end of the year. But again, if you pay 90% of it and then you true up by the time you pay your taxes and file for your tax return there by April 15th of the following year, then you're in good stead. If you are uncertain again, then you can pay 100% of your taxes from last year, provided that your adjusted gross income was not over $150,000 if you're married filing joint, or $75,000 if you're a single filer. So if you have that level of income or less, if you just pay the same amount that you did last year, then you will not be penalized for an underpayment. If you made more than that the prior year, or you're projected to make more than that, more than $150,000 again if you're married filing joint, more than $75,000 as a single filer, then you need to pay 110% of last year. So again, let's just say you had $200,000 of income and you owed $25,000 of tax on that level of income and you were married filing joint, if you paid $27,500, so 110% of the $25,000, then you're in good stead, even if you sold a property that gave you another $200,000 of capital gain. Now, you'll still have to pay the capital gain, and you'll still have to pay it by the time you file there. But it gives you enough that you'll have paid in an estimated tax that you won't be penalized just for not paying enough through the course of the year. Again, you can't get away from the tax that is due, and you need to true up by the time, again, that you file, but it does give you a grace period to kind of figure things out in that first quarter up to, again, the time that you file for taxes there.
Right. And one thing that you can always do is pay based on your annualized income. And so if you know that your income is going to be lumpy, there might be certain seasons where you know that you make more money, or certain months where you know, let's say you sell cars or sell real estate, where maybe there are certain months where you're like, I'm going to do really well in these months because I always have in the past. We'll just make quarterly payments based on what you estimate your annual income is. Again, this means that you might have to keep more on the sidelines in cash to be able to do that. But again, the IRS wants you to be making those payments as if you have that annual income. So just make sure that you are calculating this with your CPA every time that you go through this.
Overall, I think as we incorporate this in the financial plan, it gives us a lot of opportunities to make sure that we're on the right track, both with our tax payments and our financial plan. So it gives us this opportunity, again, to stay in control of the situation. As always, if you have any questions, leave them in the comment section below, and we'll look forward to seeing you next time.
If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.